Hello friends, welcome to Learning with Z. This is the sixth video in the series of Introduction to Macroeconomics. The topic for this video is Budget and Economy. Let us look at the definition of government budget. Government budget is a statement of various financial programs and policies designed by the government for a country for the fiscal year, with the estimates of receipts and expenditure of the government in order to achieve economic growth and development and stability. The government budget has several objectives. The major objectives of the government budget are: first, economic growth and stability. This is the principal objective of any government. Every government tries to formulate such programs and policy that leads to higher GDP growth. The second major objective is generating employment opportunities. In every government budget, it is ensured that employment opportunities are generated and the rate of unemployment reduces in the country. In the government budget, the government tries to ensure that there is a proper allocation of resources that happens amongst the various sectors of the economy. By this, the government tries to ensure a balanced growth in the economy. Fourth point is addressing regional disparities. The government tries to ensure that proper allocation of funds happen to the backward regions of the country and to bring them in the streamline with the other developed areas. These programs include developing special economic zones in the backward areas. Fifth point is reducing inequalities of income and wealth. By ensuring proper tax rates, subsidies, etc., the government tries to reduce the gap between the rich and the poor in the economy. Every government tries to ensure that proper production of goods and services are happening in the country and money supply is controlled from time to control inflation. By introducing proper interest rates and money market measures, the government tries to control inflation and bring it down to adequate levels. Seventh point is favorable balance of payments. The government tries to ensure that proper allocation of resources are happening to the export sector of the economy. By controlling the export duties and import duties, the government tries to strike a favorable balance of payments for the country. The government budget also ensures that at all times the Reserve Bank of India has adequate foreign exchange reserves with itself. Also, the government budget takes a note of managing the public enterprises, that is, the decisions of whether to disinvest in a public enterprise or to increase stake in any other public enterprise, like railways. Now let us take a look at the components of budget. The budget comprises of two components, budget receipts and budget expenditure. Let us look at each component in detail. Budget receipts. Budget receipts can further be classified as revenue receipts and capital receipts. Revenue receipts can be of two types, either tax receipts or non-tax receipts. Tax receipts include direct taxes like income tax or indirect tax like GST, which is a value-added tax. And non-tax receipts would include fees from various government services, fines, donations, charities, and income from public enterprises, like dividend from a public sector company, shares. The other component of receipt is capital receipts. It includes recovery of loans. The government generally gives loans to other nations, so if the loan is recovered, this leads to a capital receipt. Borrowings. If the government wants money, it can go to international banks like World Bank or International Monetary Fund or other countries for loans. Also disinvestment, like the government might think of selling stake in public sector company to raise funds. The major difference between revenue receipt and capital receipt is that the capital receipt either creates a liability like borrowings and reduces an asset like recovery of loans. But in case of revenue receipt, there is no creation of liability or no reduction in asset. Budget expenditure. Budget expenditure refers to the outflow of funds of the government. It can be of two types, revenue expenditure or capital expenditure. Let us look at each component now. Revenue expenditure refers to the expenditure which are incurred on wages of government employees or expenditure on subsidies, on defense purchases, etc. Whereas capital expenditures include granting loans to other governments or other institutions or banks, or expenditure on purchase of fixed assets like land, building, or acquiring stake in a company, etc. Again, the difference between revenue expenditure and capital expenditure is that of assets and liabilities. Whereas capital expenditure helps to create assets and reduce liabilities, the revenue expenditure has nothing to do with creation of assets or reducing of the liabilities. It is the normal recurring expenditures of the government. Now, depending on the receipt and expenditure status of the government, the budget can be of three types: balanced budget, surplus budget, or a deficit budget. First, balanced budget. Balanced budget is a budget where the government receipts is equal to the government expenditure. This is an ideal situation, but it's hard to find in the real world. What is normal is the surplus or the deficit situation. Let us look at the surplus budget first. In case of surplus budget, the estimated government receipts are higher than the estimated government expenditure. Although it sounds like a favorable situation, however, it could prove unhealthy or detrimental if it is not leading to any economic growth. That is, the government is not making proper expenditure towards developmental activities, generating employment, etc. The third type of budget is deficit budget. It refers to estimated government receipts being lower than estimated government expenditure. However, it may not sound like a favorable situation, as the government may be running out of money for essential growth and developmental related activities, or it reflects a lot of borrowings by the government in form of payment of interest, payment of loans. This leads to inflation, depletion of foreign exchange reserves, and ultimately inflationary situations in the country. On the positive side, a deficit budget reflects that a government has a lot of planned developmental programs in pipeline for economic growth, and that is why it is running into deficit. So in order to verify whether the budget is because of planned developmental activities or it is due to the fiscal indiscipline of the government, we further dissect the deficit into three types as revenue deficit, fiscal deficit, and primary deficit. Let us look at each one of the situation in brief. In general, budget deficit is defined as a situation where total government expenditure exceeds total receipt. Now, deficit can be either revenue deficit or fiscal deficit or primary deficit. Revenue deficit is when revenue expenditures are higher than revenue receipts. It could be due to lower tax collections or excess subsidies being granted by the government or excess of defense expenditure done by the government in a year, etc. Fiscal deficit is a situation where total budget expenditures are higher than budget receipts, X of borrowings, that is excluding borrowings. This reflects the extent to which borrowings are required by the government. What it essentially means is that over and above the receipts that the government has, how much money it wants by way of borrowings in order to meet the budgeted expenditures. The higher the fiscal deficit, higher is the need of the borrowing. The third is primary deficit. Primary deficit is the difference between current year's fiscal deficit and interest payments on previous borrowings. It reflects the extent of borrowings required even when interest payments are not accounted for. This is fiscal indiscipline of the government. What it essentially means is that even when interest obligations are set aside, how much is the extent of borrowings that the government has to repay to others? So friends, in this crisp less than 10 minutes video, I have tried to incorporate all important points related to government budget. I hope you enjoyed watching this video and found it useful. If you like it, Please share it and press the subscribe button and the bell icon for the updates. Thank you.